Let's take a look at Chapter 16. The Chapter 16 is about forecasting financials, the AFN equation, which stands for additional funds needed, and then kind of thinking through how to forecast and how to determine how much money we need to support future growth. So the AFN equation will be one of the big topics for the week. So they're going to give us an example of how this works, and you can see here we have a company's balance sheet, the asset section of it. 2019 is actual, 2020 is an estimate, and you can see that numbers are going up. Cash will increase, receivables, inventories, and fixed assets will also go up. Then we have the liability and equity section, and we expect accruals to go up, AP and accruals. Notes payable, we're going to borrow some money. Long-term debt will go up by 80, and then common stock does not change because we're not issuing stock, we're just going to borrow some money. And then retained earnings goes up, which shows us that they should hopefully be profitable and have net income then. And then here's the income statement. Sales will go up quite a bit, from 2 million to 2.5 million. Variable costs will go up, which makes sense if sales go up. Fixed costs go up a little bit too. They bought some property, plant, and equipment type assets, the 500 to 625. That's probably part of the reason that would go up. And then interest goes up. They borrowed more money, therefore more interest expense. Then they have EBT, or EBIT. I should mention EBIT first. Earnings before interest and tax. Subtract the interest. Then we get EBT, earnings before tax. Tax is the net income. And then what they do is they take 1/3, 30% of net income is paid out as dividends. So the net amount then goes to be an increase in retained earnings. So this 55.1 right here is this increase right here from 200 to 255. Okay, then we have some ratios for the company. So 19 is the actual, 20 is what they believe will happen, and then compared to the industry average. And you can see for the vast majority, we're not as good as the industry. A couple of them were okay, but the vast majority were not as good. So we're poor compared to what the industry has done. So I want everybody to kind of see that. And it says here some key assumptions in preliminary financial forecast for NWC, which is net working capital. So right now we're at full capacity in 2019. And recall that we want to grow. We're going to go from 2 billion, actually we're in millions, so we're at 2 billion, we're going to go up to 2.5 billion. So we expect to grow sales by 25%. So the triangle is called the delta symbol, and that just means change in sales is 25%. It also mentions each type of asset will grow proportionally with sales. Payables and accruals also grow with sales, and the profit margin and payout ratio will be maintained in the next year in 20. Okay, so the key assumptions that go into a forecast are right there. And so this is the AFN equation. Again, it stands for additional funds needed. And A is assets, and then S is sales, and 0 is now. So my assets today divided by my sales today multiplied by my change in sales. Okay, so assets is the 1,000, or really it's in billions, 2 billion, and then the $500 million change in sales. So that's that ratio of basically how many assets does it take to have a dollar of sales, and that's what we're trying to figure out. Then we take the liability, kind of the same thing. L0 is liabilities today, S is sales today, and the change in sales again. And then M is margin, which stands for profit margin. And then we multiply that by S1, which is the sales next year, and then 1 minus the payout. And the payout ratio is what percent of earnings are paid out to our shareholders as dividends. So the first part of this ratio is trying to help us figure out what percent of sales are needed matched against assets. So what's that ratio of asset to sales? The second part is liabilities to sales, and the third part is net income. So we're trying to figure out, as we grow, how many more assets do we need? We then subtract from that the growth in liabilities. Remember that liabilities and accruals will naturally grow, especially your accounts payable and accruals. Will just grow as the sales grow. And then net income can be used to help offset the cost of assets. Net income that we keep, basically the increase in retained earnings. So this last portion is the net increase in retained earnings that we expect to have next year. So profit margin times next year's sales times 1 minus the payout ratio. And we get basically 169.9 million or $170 million. So as we look at that forecast, remember that we're kind of just assuming the next year is the same as this year when it comes to key ratios. And obviously what all companies should be doing is looking at their ratios and going, what can we improve on? What are some strategies we can undertake to improve some of these numbers? So, one that really stands out, day sales outstanding, 43.8 versus 32 for the industry. We should be thinking about how do we improve that number? How do we get that better? And so it says here, we're going to consult with management, and it says we're going to expect customers to pay quicker next year. So we're going to undertake some strategies to reduce DSO from the 43.8 down to 34 and get it closer to the industry average. And the key is without affecting sales. We also will be investing in a new facility that will boost net fixed assets to $700 million. And then new inventory system will be purchased so we can better manage our inventory. And we expect inventory to be at 10 times without affecting sales. So look at the inventory up here. We're at 8.33. 11 is the industry. We think that we can get to 10 without negatively impacting sales. And that's the key with anything involving collecting faster or improving on your inventory, is we do that without negatively impacting sales, because if we get tighter with our credit, we may have fewer customers, or we may alienate current customers as we attempt to collect faster. So that's a concern. And then the bottom one down here is inventory. We need to get better at it, and the goal, of course, is to get better at it, but not run short on inventory and then lose sales because we don't have enough on hand. But we're planning, we have a strategy, we have a plan, so the goal is we can change these numbers without negatively impacting sales. Okay, so obviously that will change our forecast. So these changes will lead to adjustments in the firm's assets. They have no effect on the liabilities and equity section of the balance sheet or its income statement. So now my cash position will be different than the original forecast we looked at. So I'll go back and take a look at that. So this is at slide 11. We'll go back to this one right here, and when everybody kind of see that we'll have more cash now because we're going to collect faster, and we'll have a different amount for receivables and inventory. We'll go back down to 11 here and compare them again. And then fixed asset goes up too because we're going to spend some money in some new fixed assets. So I want everybody to kind of see that the cash goes up, receivables goes down, inventory goes down, and net fixed asset goes up with those changes compared to the base case scenario. So if we're able to pull this off and do this, then a few more of our ratios will be better. Day sales outstanding will be much closer to the industry average, inventory turnover will be closer, and so on. So that those changes, assuming that they work and our plan that we put into place works, will make us better off. And then it says, what's the change in net investment capital? So the capital for 2020 is your net operating working capital. Remember, that's your current asset minus your current liability minus notes payable, plus net fixed assets. Okay, so that's the computation right there. It's 1125. It was 900 in 19, so the net investment capital change is 225, and it says all cash is used for operations. So the key assumption with that too is what is your cash used for, and we're using it for operations. So how much free cash flow will we expect to generate in 2020? We take our EBIT right here. It's going to be 93.75 minus the net investment in capital, that 225 that we just came up with. And so we'll have a negative free cash flow in 20 because we're investing in new things, new property, plant, and equipment. Now it says in 2019, the original assumption said we're at full capacity. And now we are at 85% capacity. So that means we can increase sales without the full investment needed in the previous scenario. So we can grow sales this way without having to do the full investment. So I could, my capacity is actually 2,353, if I say that right, is what my capacity is if I'm at full capacity. So remember that we expect to go to 2.5 billion, so I wouldn't need the same investment in property, plant, and equipment to get there. So how can excess capacity affect forecasted ratios? Sales wouldn't change, but assets would be lower, so turnovers would improve. We need less new debt. That means lower interest expense and higher profits. And so in other ratios, earnings per share, return on equity, the TIE ratios, which is times interest earned, would all improve. So then they kind of pose some questions and say, if this, then what? Basically, if this happens, then what happens to the AFN equation? So remember that the AFN equation, the way it works, let me go back to where it was at. Right here is the asset section first. So as sales grow, we need more property, plant, and equipment assets. We subtract from that the increase in liabilities and the increase in retained earnings. Okay, so that the higher the second two amounts are, the lower the AFN becomes. So kind of just keep that in mind. We'll go back and look at the what ifs. So the first one is a higher dividend payout ratio. So the more dividends we pay out means there's less retained earnings, which means that the AFN would go up. A higher profit margin. Well, the higher our profit margin means more net income, more retained earnings, which would then decrease the AFN. Then higher capital intensity ratio. And the capital intensity ratio is the first part of the formula, which I did not mention, call it that. But right here, the asset to sales part of that, that's your capital intensity ratio. The more capital intensive business is, the more capital it will need in order to generate the new higher level of sales. So kind of think like a steel mill or a power plant would be much more capital intensive than a law firm. It'd be something thinking through like that. And the bottom one, what if we hold on to our money longer? We make a decision to pay suppliers in 60 days rather than in 30 days. Then what? Well, obviously that would decrease AFN because our liabilities would go way up. So the more liabilities we have, the lower the AFN will be. So you get a lot of questions in your homework that'll kind of deal with that. So I just want you to be prepared. It's a little bit shorter chapter, which is good because there's a lot going on this last week of class. So I just want you to be aware of that.